Hey everyone, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's video. I've just had my 48th birthday party on the weekend. Had a huge party, lots of drinking, lots of alcohol. Definitely killed a lot of brain cells, but I've got a lot more to spare. So it's interesting. I've been doing a lot of self-reflection, nearly hitting 50 now. So, you start thinking about life, what you've accomplished, what you haven't accomplished. And I must say, looking back, throughout the last three decades, really, that I've been employed in the financial service sector, I can tell you now the quality of our life for myself, my wife, and my daughter has been extraordinary. And it's all thanks to property investing. The amount of equity that we have extracted out of our properties to buy cars, holidays, experiences is so significant that it's really changed the quality of our life. And property investing is not about becoming multi-millionaires. The reality is most of you will never become multi-millionaires, but you know what? You don't need to. You don't need to become a multi-millionaire to just have a great lifestyle in Australia. You just need hundreds of thousands of dollars in accessible equity every year at your disposal. And that gives you the ability to buy time, the ability to buy holidays in exotic locations, to go to Europe for 3 or 6 months and not worrying about bills. If there's things happening at work you're not happy, it enables you to quit, reskill, take a year off. It gives you the flexibility. And that's what really property investing is all about. It's not about becoming a multi-millionaire, because most people will never become multi-millionaires. But a lot of you can have $1 million in equity built in an investment portfolio. And a lot of you already have $1 million in equity in your home that you live in. You just probably don't know how to maximize it or how to unlock it. But I can tell you now, looking at our life, if we didn't do property, we'll still be very comfortable because we've got good wages. But I mean, property just made such a drastic impact and difference in our lives. It's just extraordinary. And anyone can do it. You just got to learn the rules of the game, so to speak. So welcome to today's update on the property market, Melbourne, June 2024. I haven't done an update since January because Melbourne's been going sideways. It's actually gone from 7 o'clock on the property clock to 9 o'clock. And I'll talk about the economy. I'll unpack the market in detail today to give you a bit of an understanding of where we are, where we're heading. But I can tell you now, this is the quiet before the storm. And I don't really think anything's going to happen this year. I think we're going to run out of time. And I'll talk about what that means in my video. And I'll also show you areas that are suffering and going backwards in Melbourne and areas that are booming and going really well. But the most important thing is when it's quiet like it is now, this is where you can get all the bargains and discounts. And this is what people don't understand is when the market's hot, you can't negotiate better terms of settlement with vendors. I just did a deal for one of my clients through a self-managed super fund where he deferred settlement on the property for 2 years, which is crazy. So he's put a deposit down, nothing to pay the further settlement on the property for 2 years. Property's going to be completed, tenanted. He still won't settle until he's ready to settle. I've also got properties where the developer is giving clients 50% cash rebates on stamp duty. We had a project in Box Hill where the developer was throwing in $100,000 towards stamp duty, and these are properties between 1.495 up to $2 million. So these kind of deals don't resurface or even exist when the market's hot and everyone's buying everything and auction clearance rates are 80-90%, because they don't need to be creative at that point in time. So as investors, you've got to be savvy, and you've got to understand you've got to do the opposite of what everyone's doing. If everyone's zigging, you zag. And Warren Buffett talks about this all the time. Be fearful when others are greedy, be greedy when others are fearful. And I subscribe to that methodology. The one thing that made me a lot of money over the last 20 years in property investing is doing the exact opposite of what everyone's doing. If the herd goes left, I go right. If the herd's buying, I refinance and lock in my equity. If the herd is selling, I'm buying. But I'm buying because I know what to buy, and the fundamentals never change. So this is the key thing. If you know your stuff, when the market's down and when the market's going sideways, you can actually discern and take action. And that's the difference between educated and uneducated investors. Educated investors can discern and take action, and that's where the money is. Always remember, guys, if you're going to read any investment books, read a book about Warren Buffett. I mean, the guy is the most successful investor of all time in the history of the world, arguably. And the number one rule, is always counter-cyclical investing, and also that at the bottom of the market, there's more opportunity than at the top of the market. And that there's a massive transfer of wealth at the bottom of the market. And the transfer of wealth flows from the uneducated to the educated. Now, I get it. I understand it's very difficult out there. Interest rates are very high. I'm seeing a lot of 7.5, 8% interest rates. 2 years ago, we were doing, 2.5. Don't forget, 2 years ago, if you listen to my YouTube channel, if you've been to my live events, I was telling people at 2% and 1.95 and 1.7, I was telling people fixed rates for 10 years. A lot of my clients fixed rates for 5, 10 years. You probably don't know this, but you can actually get 15-year fixed rates in Australia, which is the longest you can get. You got to go to fund managers and get a wholesale price. But you got to be in private banking. But when I worked for NAB, I was doing 10-year fixed rates all the time. People think 5 years is the maximum. It's not true. You can do 10 years, 7 years with a lot of lenders. And so the clients that were very they had a risk profile that was very tight, which means that they didn't have a lot of cash flow left over after paying all the expenses. They were the ones that I was telling to fix for 10 years, because while then they can't touch the asset for 10 years and refinance and get the equity, in 10 years' time, when the asset comes out of the fixed rate, it's going to be cash flow positive massively by itself. And that means that during a 10-year period of time, they've got nothing to worry about. Because always remember, property investing is always a long-term proposition. It's 5 to 10 years, 15 years. It's not 1 to 2 years. 1 to 2 years, guys, is gambling. You know what I mean? So, there are obviously investors out there that do property flipping options. We don't do that here. We just teach buy and hold, never sell blue chip properties. So it's an exciting time at the moment. I actually really like when the market's like this, because I can negotiate better terms and conditions with developers. So let's get into it. And I still have a cough, I think, from all the drinking that I did on the weekend. Being Polish, I love my vodka, and it's a silly thing. Now, before I get on any further, I must warn you, I am Polish. I'm just kidding. Well, I'm not kidding. But I must warn you that there's nothing here that I'm going to teach you today that is guaranteed to make you any money. I haven't met you before. I don't know your set of circumstances or financial standing. So this is purely for educational purposes only, etc., etc. For those of you who are not familiar with my background, I've got a YouTube channel, which obviously on property investing. I've also done a bunch of degrees, which really amounted to nothing. The most important thing is that I'm actually a property investor myself with a multi-million-dollar property portfolio right here in Melbourne. And this is what gives me the credibility and really all the credentials that I need to talk to you about what's happening in the Melbourne property market. I've been working in the financial services sector now since I left Monash University, which was over 2 decades ago. And I've been working in financial planning, mortgage broking, private banking, and also as a mortgage broker and as an asset lending specialist for Medfin, which is a subsidiary of NAB. By the way, I want to thank you guys for buying my books. I've got a #1 bestseller multiple times. Every week, my book is #1 again on Amazon and different Booktopia and different sellers. So I really want to thank you guys for supporting me, buying my book. All the wisdom of the world is contained in books. And the difference between you today and 2 years from now is the books that you read and the people that you ultimately meet and interact with. So I can tell you now, books have changed my life. In reading books, I've read over 280 books on real estate investing in Australian psychology. I've actually read every single book ever published in Australia on real estate investing since Margaret Loma's 4 books that she wrote, and then I stopped reading books on real estate about 10 years ago because it was becoming repetitive. It's the same stuff over and over. But I've read all the great books, Stephen McKnight and Margaret Lomas and Dimfta Bolholt and Michael Yardney and all the authors, Wakeling Report and et cetera, and obviously all the American books, all the Kiyosaki, Dr. Roos. And I'll tell you, you pick up 1 or 2 wisdoms of nuggets from each book and you put it together and you make it work. But books are very important to read, and I would really encourage you guys to give up watching the Idiot Box every night and spend an hour reading. On average, when I was in my 30s, I read for 10 years straight, and I would read a book in 9 to 10 days, sometimes 11 days. I would read from 9:30 p.m. to 11 o'clock at night, and I would get through a book in about 8 to 9, 10, 11 days, depending on how complex the books was. Stephen McKnight's books are very thick, and they've got a lot of charts and graphs, where some other authors have books that are shorter and much more concise. And look, that's about 30 books per year over 10 years. You read 300 books. I mean, that's how it happens. And you transform your psychology and your paradigm shifts. By the way, if you want to get a copy of my book, realestatemadesimple.com.au, you get a bunch of freebies, or also bookonfinance.com.au for my finance book, which teaches you how to smash your mortgage and repay your property in record time. Also, just for being here today, I want to give you a recording of my live event from 2 years ago, nearly 3 years now, actually, just when COVID kind of kicked off. And this will teach you the fundamentals of property investing. Now, it's still 70% the same as it was back then. Nothing's really changed in the last 5 years, except the market keeps changing. So macro level, the big picture stuff is the same in finance, in sourcing, in real estate, in where we are in the property cycle. But micro level stuff, obviously everything changes. Policies change from land tax rules down to lending policies and where we are in the property cycle hour by hour. So, but once you understand the fundamentals, all you got to do is get the updates, and then you pretty much know more than 99% of all investors out there. So by sticking to the end of this video, I'll give you the link. You can download and access this online video course for free. It will change your life if you've never invested before. This is all you need to buy the first 5 properties. Valued at $497. It's really valued at its priceless, because how much can you put on being able to buy your first investment property and making $500,000. All right, enough of shameless plugs. Let's talk about the market, what's happening right now in the market. I've always mentioned this on my YouTube channel. I love when the market's depressed, and what I do is, because developers are always under the pump, and there's massive delays now with projects in Melbourne, where developers are getting really stressed because they're paying interest per day on projects outstanding. See, developers are very simple creatures in terms of their business model. They want to build something, sell it, and get paid and get out of it as soon as they can. The moment they secure with the site, it's a liability for them, because the site's costing them money in consulting fees, in interest charges on the original property. So they want to just build, develop, get the money out and go. So every day they take longer to build something, it's costing them money and it's eroding their margins. So when I talk to developers now and they ask me, Konrad, what do you think is happening in the market? I just overplay how bad it is. I just go, oh, it's terrible. It's the worst ever. There's blood on the street and it's going to collapse, and people are living in tents. They don't even want to know about investing in property. Labor's destroying the whole economy. The Penny Wong and the Albanese government's completely useless. They're running the country into the ground in every level. It's just embarrassing how bad they are. So I kind of play into their fear, because then I go, give me a discount, okay? And then I can give it to my clients. I mean, when the market's hot, it doesn't matter what you say. No one's going to believe you. If the market's at 90% auction clearance rates and everyone's buying properties, and every story on TV talks about how one record was broken by another record, and how a single mum in Dandenong with one arm made $1 million, I mean, what are you going to say? There's nothing you can say, okay? By the way, I apologize for single mothers with one arm in Dandenong. Don't email me. So, what are you going to do? Nothing. You can't do anything. You can't leverage the situation. So all I do all the time is, because I work for my clients, ultimately, I play into the fear factor with developers, because they're human beings at the end of the day. They're not like superheroes. They don't have a crystal ball. No one knows what's going to happen in the future, but it's all cyclical. It goes up and down. It's got a cyclical nature. And so what we want to do is, and look, most developers that I work with are multimillionaires. They drive Lambos, Ferraris, Bentleys, Rolls Royces. I feel like a peasant turning up sometimes to meetings in my S63 Mercedes Benz. It's the cheapest car on the lot usually. So, I don't feel sorry for them. Okay, that's what I'm trying to say. They're well looked after, but they take a lot of risk and they make a lot of money. But sometimes they don't make money, and I've seen developers go bust. We've had over 2,000 developers and builders go bust in Australia in the last 12 months, which is unprecedented. And this is one of the pressures that we're facing with what's happening in the property market. Because remember, when a developer or a builder go bust, they go down hard. It's not like, oh, company shut down, we'll set up a new one tomorrow, we'll just have a break, No, it doesn't happen like that, guys. Now, sometimes it happens if they're dodgy, but most of them go down hard. They lose their marriage, their house, they go into depression. They don't come back. Do you know what I mean? Like, and they take out businesses with them, landscaping companies, bricklayers, sparkies, and these are small family businesses. If they have debts of, you know, 100, 200, $300,000 outstanding, they're gone. They're not going to recover. They'll probably leave the industry or move out of Victoria. So when developers go down, they take down not only the company and the immediate staff, they take down a lot of businesses with them. And this is why the Albanese government is so stupid, because they think they're going to build $1.2 million homes where the industry has been decimated and some of the best developers have exited the industry and some of the best talent has left. I mean, think about it. Metricon nearly went insolvent. The owner of Metricon committed suicide. Metricon got saved. I think they were trading insolvent. They just got saved because the new CEO sold 64 display suites and they got a $30 million line of credit through CBA and saved their ass. I mean, I had mates that worked for Metricon and they were in sales, doing a brand new house on land estates, and I'm calling them up saying, how bad is it? And they're saying, mate, we haven't got paid for 6 months. If they're not paying us, no one's getting paid, you know? So the thing is, if they're in trouble if they're not paying their frontline salespeople. There's a lot of developers went bust, and it was some of the biggest names in Australian history. These were not new companies that folded in the first 12 months. Porter Davis, a lot of these developers went down hard, and they're not going to come back into the industry. A lot of those people, once they get burnt severely, never come back. And we've only got 26 million people in Australia, and we haven't got enough people in the building industry with extreme skills to make sure that these things are built correctly. And that's why we have such issues in Australia with quality control. We're building, especially in Sydney, some of the rubbish that they're building up there in Newhouse and land estates. I mean, it's appalling. Why? Because we've got migrants building them who are not even qualified to build anything. They've got dodgy certificates that they've been bricklayers or somewhere in in another country. I'm going to pick on countries. And they come, let's say it's Poland, okay? And you can buy a certificate in Poland, the black market, that you've been a bricklayer for 10 years and you don't know anything about bricklaying, and obviously then someone hires you, you're going to be paying for it. So the dumbest thing that the government did was allow the building industry to fall. They should have provided tax-funded, interest-free loans to the industry and just get them through the COVID period, because the COVID period created this whole industry and this whole issue with the industry. And that's the biggest problem. And that's why we're going to be paying for it for the next decade or two. It will take up to 20 years to fill the talent that we've lost in 2 years during COVID. That's the reality no one's talking about. So when we're talking about building 1 million houses, from who, how, when, what? Are you insane? It's not going to happen. We haven't got the people to build them. We haven't got the developers, the entrepreneurs to build those properties. It's impossible. It's never going to happen. And that's a good thing for investors with a buy and hold strategy, by the way, because you're taking advantage of the prevailing circumstances. So one of the biggest challenges was inflation, which is now 3.6. It's definitely gone down from nearly 8%. You can see there. Apologize for the quality of that image. It's a bit pixelated, but it's the best that I could have gotten. It's still above the required range for the RBA, which is between 2 and 3%. And also, ironically, the Labor budget is inflationary. It's giving people cash and money, and wages are going up, which means people will be spending more money. What no one's really talking about is the reason inflation is so sticky and so hard to combat is because we have 4.2 million baby boomers in Australia with no mortgages. These are people that have paid off their houses, they're retired, they've switched their pension to pension phase, superannuation, I should say, to pension phase from accumulation phase. They're buying cars, they're buying trailers, they're buying boats and Harleys and whatever they're into. And how are you going to stop them from spending money? Now, they haven't got any mortgages, which means that if you increase interest rates to 8%, all that means that term deposits are getting 6 and 7%, which is good because they're actually making money. And what are you going to say to them? Oh, John and Jenny, you've worked your asses off for the last 40 years. You've built Australia. You're in your 50s and 60s now. We know that these are golden years of retirement, but we really don't want you to spend any money that you've saved up and deferred, because you're going to make it really difficult for first-time buyers to get into the market, and they really want to buy a house. Come on, you can't do anything. They've got the right to spend money. They've worked their asses off for the whole life. So this is the reason why monetary policy is such a blunt instrument, because it doesn't address 4.2 million people that are cashed up, that are baby boomers, that control majority of the assets in Australia, and also hold vast amounts of equity built into their properties, and they don't care about mortgages because they haven't got any mortgages. All they have is term deposits and cash and lines of credit, which is the reason why inflation has been so hard to combat. And there's other reasons as well. And I'm going to do a whole YouTube video just on inflation and interest rates in the future, just to unpack that topic in more kind of, in more detail. But once again, definitely we've had massive increases in the cost of living expenses, food, electricity, health insurance, premiums, everything's going through the roof. The biggest challenge, though, is, and I'm not here for social commentary, by the way, this is not a YouTube channel based on, talking about what's happening in the economy. But the reason I'm telling you is because the cost of materials is going through the roof as well. Timber construction, timber frames and aluminium frames have virtually gone up by 100% in the last 2 years. Even like tiles, white goods, double digits. So the problem is, and I speak to developers all day long, even without any capital growth from the human factor, just to build a 2-bedroom townhouse, let's say in Heidelberg Heights, right, which is like a mid-range suburb, you're looking at 750. It's 12K from the city in Melbourne going through gentrification. So a 2-bedder for 750 today, next year's same time will cost 805,000 because it's going to go up by 55,000 just to build. 3-bedders will go up by about 65 to 75,000, and 4-bedders will go up to about 75,000 to 100,000, depending on configuration. So just replacing the same product is going to go up just based on inflation, but not only inflation, specific things that make up a property are going up in price at an unprecedented level. And then you're going to be paying for it because whether you're buying a new or old, new properties set the new price points for all the properties. So the whole market goes up and then you pay for it. So even if we don't have any capital growth at all and we're sitting at zero, you're still going to be paying more for the same property 12 months from now, whether you like it or not, because of replacement value, because land's going up and cost of materials are going up. So Melbourne's going to go up by 6 or 7% just in construction of materials. And on top of that, you have then the capital growth factor based on prestige, location, supply and demand, income demographics, all those topics that I talk about in my other YouTube channels. So you got to understand, the moment, if you don't get in today, you'll be paying the same amount of money for the same product more next year and the year after, up to 50 to 100,000. That's the reality, and that's based on me talking to developers that are doing 400 or 500 builds per year. One of the biggest casualties right now of what's happening in the market is people are experiencing extreme mortgage stress. And mortgage stress, by the way, by definition, is someone that has missed 3 repayments on their home, which means by definition they can legally lose their home and the house can be repossessed and sold. And these areas, this is a heat map showing you the lowest and highest people with exposure to mortgage stress suburbs. And it's really concentrated in the 4 growth corridors of Melbourne. It's the alcohol still kicking in. I still have vodka in my system from my birthday party. Apologies for that. And so you can see there on the heat map, you can see the suburbs that are extremely mortgage stressed, and this is the increase of mortgage stress levels. So Melbourne City, for example, April 23, 2.3%. Now it's 2.7. So 3 out of 100 homes are 90 days in arrears with their mortgage. And these are usually apartments, South Bank, Docklands, and not so much the city itself, but surrounding the city. Dandenong, from 2003, 2004, 4.9 to 2.8, for example. So a lot of house and land estates, a lot of established properties as well. But once again, you have very much a blue collar, workforce that is working in, factories, working with their hands, and they're the ones that are losing jobs. And a lot of tourism, a lot of hospitality, a lot of cafes and small businesses are shutting down. I recently watched ABC News, which I avoid like a Tina Arena concert because it's very left-wing, but they were talking about 1,000 businesses in Australia shutting down every day now. And a lot of them are cafes and restaurants because people are now cutting back on coffees and just delaying eating out. So all that stuff is down. So a lot of cafes, and I've just noticed myself, just being a creature of habit in Melbourne, like everyone else, a lot of the cafes, well, I go to for coffee, which is Brighton East, Bentley Centre Road, and Fitzroy Street, St Kilda, because my office is in the Bayside. A lot of the cafes have shut down. They've been open since, for 20, 30 years. They're shutting down for the first time. So it's unfortunate, but it is what it is. You can see that these are some of the areas that went backwards in the last 5 years. This is as of last month from the main. So Brunswick West, 9%, negative. Braybrook, 5.7, Oak Park, 5.1, Broadmeadows, 4.5, Clayton, 3.2, Pascoe Vale, 1.5, Carlton, Box Hill. Now remember, then these areas went up: North Melbourne, Glenroy, Carlton North, Heidelberg West, Elwood, Leverton, Leverton and Elwood. What a difference in suburbs. 2 million versus 580,000 for a house. Fitzroy North, Ascot Vale, St Albans, Ivanhoe, Windsor, Sunshine North, 6.1. Remember, capital growth, but measured by median price, is just the middle property sold in one market compared to a middle property sold in another market. It's not a very good way of measuring what the market's doing. And this gives you a really good illustration where you got Brunswick West, -9, Sunshine North, 6.1. But what does it really mean? It doesn't mean much, really, because short-term movements in median price, whether it's over 5 years, 10 years, 1 year, 6 months, you can't cluster. You can't put Elwood and Leverton together. It's just nonsense statistics. You got to separate Elwood. Even within Elwood, there are good streets and bad streets. Even in Leverton, there are good streets and worse streets. So you got to go to micro level due diligence with these suburbs. You can't just take it at face value. There's a lot of new properties being built in Leverton as well. So, you're going to have times where Leverton is doing 30% growth and suddenly it's doing -5% growth. It's based also on the volume of sales, difference between new and old. In terms of apartments, you can see there, Carlton, Coburg, -33, -18, Malvern East, 13.8. And this is it could be a number of factors. Most of the stuff with apartments is these are getting resold in the first 3 years. There's a big chunk of apartments back on the market after 3 years, which means someone bought them just before COVID and then they settled them and now they want to sell them and they're dumping them. And also, number two, people are buying cheaper apartments. So the price point is changing because rather than going for a higher end 2-bedroom, they're going into entry level 2-bedroom, or rather doing a 2-bedroom, 2-bathroom, single car garage, they're going 2-bedroom, 1-bathroom, or 1.5, which is cheaper and less floor space. But once again, it gives you an indication of what what apartments are doing. Apartments have really been smashed by COVID. People don't want to be stuck on balconies. They'll rather be locked up in the property, in a house if they can. So apartments have lost favor, I guess, with the market to a massive extent. Now, I think apartments are a great opportunity if you want to do it over long term. Like right now is a good time to buy. I mean, looking at this map, I don't like Carlton or Carlton, I would buy a Victorian terrace home. I wouldn't touch apartments in Carlton. Coburg, I would buy all the weatherboard Victorian. Malvern East, yeah, boring. I don't do anything in Malvern East. It's just Chatston rezone Malvern East. Footscray West, wouldn't touch apartments with a 10-foot pole. Footscray West is a great suburb for townhouses and detached houses. Melbourne, they don't touch. North Melbourne, yeah, North Melbourne, I would do a 2-bedder. North Melbourne's fine. 2-bedroom, 2-bathroom. Try to get 2-car garages. Oakley apartments don't work at all. I don't even know why they're building apartments out there. It's a stupid idea. So Oakley, you need a big Victorian house or a townhouse. Glen Waverley, nah, forget it. It's detached houses. Brunswick West, yeah, Brunswick West, I would do it 1 and 2 better. Springvale, forget about apartments. St Kilda is probably the best suburb for apartments. You can buy apartments all day long in St Kilda, do really well. St Kilda East, St Kilda West, 1, 2 bedders, 3 bedders. The bigger the better. Chatston, forget about Chatston. It's boring suburbia. There's nothing good about Chatston, Cecil. Chatston Shopping Centre. But Chatston is just big houses on big blocks. No one's living in apartments in Chatston. Glen Huntly, yeah. Glen Huntly, you could do Art Deco apartments. Windsor is great for apartments. So Windsor, I would say Windsor would be in the top 10 suburbs in Melbourne for apartments. And I'll be buying Art Deco apartments in Windsor with a large land component for subdivision potential in the future, because I think a lot of parts of Windsor are going to be eventually rezoned high density. So imagine you're buying 1,000 square meters. There's like 6 little Art Deco apartments. Everyone owns 200 square meters of land. Developer comes along and says, hey, your 2 bedders is worth $1 million. I'll give you $3 million today. And that's how people make a killing. So Windsor's phenomenal suburb for apartments. But once again, I wouldn't touch brand new. I would do old Art Deco apartments with a land component. Docklands is a disaster. It's if you want to lose money, by all means, buy Docklands. Glen Iris is actually fantastic for apartments, brand new, and also established. Glen Iris would probably be top 5 best suburbs in Melbourne for apartments. It's still cheap. When the apartment market takes off, which will be Toorak, Glen Iris, Hawthorn, Camberwell, Canterbury, all the Surrey Hills, Mont Albert North, all those areas, Glen Iris will take off with it. There's houses in Glen Iris selling for $5-6 million. So, to get a two-bedder there for 660, 700, guys, those things will go to $1 million and very quickly. And they've done nothing for 10 years because I was selling Glen Iris 10 years ago. So Caulfield South, yeah, maybe if it's a big 3-bedroom apartment. Heidelberg, forget about apartments in Heidelberg or Heidelberg Heights or West. It's all townhouses. Bentley East, I would do I like apartments in Bentley East, no problem. And Caulfield North, it's more for houses. I wouldn't touch it. So that's kind of my summary of apartments. It's so suburb specific, guys. And in the suburb, there are school zones, there are parks. Then there's the developer, the configuration of the project. You can watch my other YouTube videos on apartments. It's just very difficult to navigate through. You've almost have to be more sophisticated with apartments than with houses and townhouses because they're just easy. Because remember, with apartments, there's no land component, guys. With a townhouse or a house, you own the land. It's a very different investment. And this is why the gap between houses and apartments in Melbourne and Sydney has escalated, and houses are going up in value more so, and apartments are stagnating and going sideways. And the gap is getting bigger and bigger. And you can see there, at the moment, this is for median house and unit combined capital cities. From January 2004 to January 24, which is 20 years, you can see the growth there. The gap between houses, the average median price, or the median price, I should say the average median, it's still the alcohol, right? Kill those brain cells. 944,229, where the median price for probably a 2-bedroom apartment would be 650. So the gap is quite significant, nearly $300,000. And I've seen it up to $500,000, in suburbs. Plus, if you look at Toorak or Bowen, it'll be much more because the houses are selling for 2.5, and 2-bedders are going for 650, 750. In fact, as I mentioned before, you got to have that magic formula. The greater the gap between the median price of a house in a suburb and an apartment, the greater the gap or the ratio, the more capital growth pressure there is on that property. So, for example, if you're buying a 2-bedroom in Toorak for 650 and a house is 2.5 million, or 3 million, that's like a huge multiple of those apartments. But if you're going to Mitcham, for example, and you can get a house in Mitcham for 750 or a 2-bedder for 700, well, why would you buy a 2-bedroom apartment in Mitcham? Even on Maroondah Highway, we can get a detached house for the same price of the land. I mean, it doesn't make sense, right? So the greater the gap between the median prices of detached houses and apartments, the more pressure there is on that product. And it doesn't even compete with that product because it's in Toorak, you ain't got $3 million, you're not buying a house, right? But everyone can borrow $750. You can still get into a 2-bedroom apartment in Toorak, but not everyone can get into a $3 million property. So in terms of like properties, you can see there, we in Australia love houses and we love townhouses. I mean, look at the growth. It's been crazy. The premium for houses has been 45.2% in terms of difference between apartments and detached houses. And it's continuing, it's going to go even sharp upwards because more migrants are coming in from China and India and Europe, and they all prefer, houses. We don't want to live in apartments yet in Melbourne, in most areas. There are exceptions, and I've done YouTube videos on apartments, and they definitely work. Let's talk about the macro level and the micro level property market, which is happening right now in Australia. First thing is, I know I sound like a broken record. The market is worth $10.6 trillion, the real estate market. We have $2.3 trillion outstanding debt, which is around 20%. We've got 80% equity. We're in a good place, guys. Nothing is going to crumble. There is no Armageddon. There's not going to be bloodbath on the streets. There's not going to be any collapse in the housing market. 56.2% of Our wealth in Australia is locked up in residential property. The superannuation pool is only worth 3.7 trillion. The ASX is 3.2, right? Which is like 3 times smaller than the combined value of residential property, and commercial property is 1.2 trillion. So in terms of what we have all our money locked up in real estate, in the banking system, in the financial service sector. It's all reliant on real estate. We hold majority of our wealth in Australia in real estate. It's not going away anytime soon, guys. And because of the extreme fragmentation of suburbs and the difference between quality of suburbs, i.e. St. Albans in Melbourne, we got to wear bulletproof vests if you want to get a coffee, versus, I don't know, Windsor, Melbourne, where you're just walking around with a doggy and people going, hello, how are you today? Good, great, without getting a chance of machete, So there's a big difference between suburbs in Melbourne. There is no uniform suburb in Melbourne. And what's happening is the rich are getting richer and the poor are getting poorer. And division of wealth is coming down to ownership of property and ownership of houses specifically. Over 3 months, Australia combined major capital cities has gone up by 1.8%. 12 months, 8.7%. And so a record of 9.2 gain over 12 months to February. The annual growth trend, the national values have eased 50% basis points, 8.7 rise over the year to April, which is really good. So we're in a good place. The market's not crashing. The market's just going sideways. It's having, not everywhere, but in Melbourne, and then it's having a breather. You can see their 3 months change. Australia 1.8, combined regionals 2.1, combined capitals 1.7. Melbourne's done 0 for 3 months to April 24. You can see there's 0, just going sideways. Taking a breather before it takes off. And that's what's going to happen. Mark my words. Sydney's doing 1.1. Brisbane's 3.1. Adelaide's 3.3. Perth is going 6%. So a lot of people are saying, a lot of these commentators, and they're so young, oh, Brisbane's the number one performer. Perth is the number one. Who gives a shit? Seriously. It doesn't we're not in a horse race here, guys. We're doing long-term buy and hold. Perth is doing 6%, but Perth was doing nothing for years. It's not a competition who does what every month. So they're saying this is the hottest market. Be wary of these hot spotting reports, because the problem is this, guys. People will say when Melbourne's doing 10%, they'll say Melbourne's doing 10% by Pakenham and House and Land. Well, Pakenham's not freaking Melbourne. Do you know what I mean? The growth in Melbourne is not going to be attributed to house and land packages in Pakenham and Berwick or Trigonina Tarneit. It's going to be because of core suburbs. So a lot of these marketing companies that I'm seeing popping up with these special secret reports that that are just going to make you millions of dollars because they love you. They go, Melbourne's doing well, or Perth is doing well, house and land, rubbish, and this is the catch. It should be illegal, but it's not, because it's all like, oh, we're about to go into this cycle, buy there. But it's never like this cycle, buy Elwood in Melbourne or Port Melbourne. It's always, oh, we're going into the growth cycle, buy something 100 k's from the city, which no one wants to live in, and you're going to get macheted at night. Yeah, that sounds great. Sign me up for that property. Just, so much. You just got to be wary with these special reports. Guys, nothing's changed in Melbourne in 10 years. Elwood is still fantastic and St. Albans is still shit. Nothing's changed. No one from Elwood go to St. Albans. People from St. Albans only come across to Elwood if they want to do a home invasion, okay? And that's not going to change anytime soon. So, you just got to stick to the fundamentals. Forget about these short-term fluctuations in the market that are people obsessed about. It's a form of gambling. So 12 months average, Australia 8.7, which is pretty healthy. Like 8.7, nothing wrong with that. Combined regional 6.4. Regionals have come off because of sea change and tree change. People have left Melbourne during COVID-19 lockdowns. They said, stuff Melbourne. I had enough of Dan Andrews. I want to go out and live in Whoop Whoop. And then they go to Whoop Whoop, get a bit of a house. It's all fantastic, except then they go to town and everything's closed at 6 o'clock and there's one pub open. And they go, well, what happens after 6? Oh, we just go to sleep at 7:30. What do you mean sleep? What, are you sick? Why would you go to sleep at 7:30? Well, we get up at 5. But where are the bars? Where are where are the rooftop garden? Oh, we haven't got any of those. Yeah, we just stay home and then we go to sleep. Oh, back to Melbourne. And that's what's happened, right? So everyone's back to Melbourne, and because we have the best nightlife here, like in Sydney. People go out till 3, 4 in the morning, cafes, restaurants, cities buzzing with life. Anyway, it is what it is. That's why regional towns have come off, because people have moved there and they've moved back, and they've gone back to the norm. So this 20, 30% short-term fluctuation that everyone was talking about, I told people on my YouTube channel, it's going to be short-lived. Bendigo, Ballarat, they're fantastic markets. Okay, Shepparton, Warrnambool, there's no problems. You just can't, Bendigo just can't grow by 20% every year. It did that when people moved there from Melbourne to get away from the lockdowns, but a lot of them have moved back since. And Bendigo still does really well. It's going to continue on to be one of the greatest regional towns in Australia. So it's all cyclical, guys. It goes up and down. This is the capital cities. So if you look at this is Australian capital cities rolling quarterly changes. So you can see you have Adelaide 3.3 leading the way. Then you have Brisbane 3.1, Sydney 1.1, Melbourne 0. And then you have the other markets, which are counter-cyclical to the first four, which you have Perth 6%, and then you've got ACT 1%, Darwin 1%, and then Hobart 0.8%. This is a very important graph, I should say, bar graph, because it really shows you the beginning of where the next cycle will be. And this is one of the most important things. If you understand this will make you a lot of money. So the market is always divided into percentiles. You have the 25th percentile, which is the cheapest property in the market. And then you have the 50th percentile, which is kind of the bulk middle section, and the 75th percentile, which is the most expensive property. And by the way, there's a big difference between Sydney and Adelaide in terms of percentiles, where, in Sydney, like 75th percentile will be 3 million plus, and in Adelaide it'll be 1 million plus, okay? But what happens is, whenever you enter the next part of the growth cycle, and remember, and I'll talk about the cycle in a second, but the roughly, and this is really rough, it's changing a lot. It's 10 years around the clock, okay, for a major capital city, but it's changing as well. We've had half resets, we've had all sorts of stuff because of the GFC, because of COVID. So we've had abnormalities emerge that were not factored into the normal cycle. But roughly, when the market starts to go into growth phase, the 75% of the most expensive properties lead the way, and then the middle section goes second, and then the third section goes last. And Sydney always goes first, then Melbourne, and then Brisbane, okay, because they're the biggest markets by volume. So what's happening now is, you can see that Sydney's just started to take off. Melbourne is still negative at 75th percentile, because remember, when rich people have a house in Brighton for $6-7 million, if they're not getting $7 million, they don't need to sell. There's no mortgage on that property. So they pull the property off the market and the volume drops. And that's why you have a median price decrease. Not so much because they're losing money, it's just the middle property moves to the left because the volume decreases. That's why you have negative 0.4 in Melbourne for the 75 percentile, and in Sydney it's 0.5. So we're just at the beginning of the growth phase. We're taking a breather before we take off, guys. And when we take off in Melbourne, I don't know if it's going to happen this year or the beginning of next year. We need a couple of interest rate cuts, but when it does happen, people are going to be shocked and horrified if they haven't got property. If they got property, it's jackpot time. You're going to be sitting on so much money, you won't even know what to do with yourself. Well, you'll spend it. So housing cycles are very important. It's all cyclical. This is the 28-day rolling average. Because it gives you, it's kind of like the pulse of the market, I guess. Now, 1 month is not a long period of time in the market. The market kind of moves quarterly. 28 days is virtually nothing. You can see there, Sydney, and this is a really good kind of a summary of where the market is. It shows you the kind of cyclical nature of the market, and also gives you the volume of sales. So in April, Sydney values rose by 0.4%, over the quarter 1.1, over the past year 8.7. And then you can see where Sydney dwelling would now 0.8% below the record high, which was in January 22. So it's gone up, and then it's going down, and it'll go down, and it'll go up again, and it has a correction. Melbourne is going down, and it'll go down even below that line. We can even go into a correction a little bit, dip in, and then it's going to go up again. And then, so it's kind of going down now. It can even go further below the 0% line. We could go negative next year. I can see that happening. and then it will take off, and then we'll just go bang. And it's going to go up by 20%, 25%. Mark my words. Mark my words. So $1 million properties will go to 1.25, 1.3, $800,000 properties will go to $1 million. And then the bottom will get dragged up as well, which is your St. Albans, Glenroy, Sunshine West, and everything else. So first you got your Toorak, Hawthorn, Brighton, or your high-end suburbs, Essendon. Then you have your mid-range suburbs, your normal suburbs, right? And then you got your bottom suburbs getting dragged up. So buying at the bottom is the key to make money. Brisbane's already taken off before us, and Adelaide as well. And then you got Perth, and then Hobart's about to go down even further. So you had a big change in Hobart. People moved from Melbourne to Hobart during the COVID lockdown. I had a lot of my friends move there permanently, and they love it up there. Hobart's great. It's green. It's very kind of it's got this alternative, obviously depending on the suburb, but the cafes, restaurants, you've got all that stuff there that you have in Melbourne. So it's just a fraction of the price, and it's a good community there. So people love it out there. In fact, all the people that I know that moved to Hobart have not come back to Melbourne, but people that I know that have moved to regional towns like Bendigo, Ballarat from Melbourne, they've come back. So Hobart's quite good. Darwin's the same. Darwin's going into an upward growth trend now. Canberra's the same. Listings and volume of sales. This is kind of, I don't know if this is useful information. It's more just statistical. Like in the 4 weeks of May, fifth new listings totaled 39,072 nationally. So what? Doesn't mean anything. The listing trends have been a slight upstick in recent weeks due to part earlier than usual Easter. The 4 weeks count of new listings coming in at 18.3, above the same time last year. Yeah, it doesn't really tell us much. So listings, look, you got to do listings per suburb, and this is where it has a massive impact, because some of the best suburbs in Melbourne, the listings are down 30-40% from their normal volume, because people have mortgages that are paid off, houses that are unencumbered, and they take them off the market if they can't get the price. So this is where it does make an impact, but it's very micro level, suburb specific. When you go macro level with listings, it can be very misleading at the best of times. It does indicate how confident people are getting in the price, but beyond that, I wouldn't pay too much attention at a macro level. Across capital cities, the change in total listing levels last year is quite diverse, ranging from 10.6 in Melbourne to negative 24.9 in Perth. So it goes up and down. It doesn't really give you a lot of stuff in terms of that. So I'll just skip that. Median days on the market, I like that indicator. Like, for example, in Melbourne, in April 23rd, it would take 29 days to sell a house. Now in April 24, it's 36. So it takes 7 days longer now to sell a house in Melbourne. Medians on the market. So in Australia, it takes now, in 23 was 30 days to sell a house. Now it's 31. So it's taking 1 day longer. Combined regionals, 40 days last year, 23 to 44 now. And then capitals, 27, which means it's going sideways. So look, if the market's hot, it takes a shorter period of time to sell houses because they get sold before auctions, and so people pay for them before auctions, and they run out the door. If the market's more depressed and conservative, it takes many more days to sell each property. But also don't forget that Melbourne and Sydney sell a lot of properties through the auction process, which gives you a very good auction clearance rate and guarantee of sale, 60%, 70%, where, for example, in Darwin, they don't do a lot of auctions, or Canberra. Adelaide's the same. There's suburbs where they don't do auctions. Vendor discounting is a good indicator. So in Melbourne, for example, if you look at 2003, 4% vendor discount, now it's 3.3, so it's dropping. For Australia, 4.2 to 3.5, so it's less vendor discounting. So this is where vendors are discounting the property, the agents negotiate a better price, or the property simply got passed in at auction, and then Monday or after the auction, people have made an offer, and that offer was accepted. Might be below the actual vendor reserve, but it's accepted, and so it gives you the kind of an indicator of the pulse of the market, I guess, and what people are kind of feeling, and what they're where they think the economy is going, how confident they are with their jobs, finance, etc. So it's a good indicator, definitely, but it's suburb by suburb specific. Weekly auction clearance rates are definitely suburb specific, but it gives you kind of a pulse. So although down from the pre-Easter spike, 3,519, capital city auction activity led relatively steady over the 4 weeks to April 28th. with an average of 1,957 auctions across the capital cities. The auction clear rate's now around 66%, so no problem. Rental market's a disaster for tenants, complete disaster, guys. I have never seen anything like this, and it's Labor's fault. It's actually a perfect storm of different things happening. Number one is we have 3,000 developers, builders go bust, so there's less volume on the market. Number two, we've had 600,000 migrants come in, nearly a million now over the last 3 years, with no solutions for housing. Escalations of costs, interest rates going up to the point where the average income earner can't afford to buy anything, so they have to rent. They've been defaulted to renting, and then very low rental volume available in suburbs, which is fantastic for landlords like myself because I'm getting record prices for my properties. I just feel sorry for tenants because when we do opens now, you get an average townhouse in Bentley. We used to get 10, 15 couples through on a Saturday. Now I'm turning up and there's 50, 60 people waiting in line to go through a new townhouse, and then they have, stress because there's 60 applications there. People are paying 6 months, 12 months up front. It's a disaster and there's no solution for it. And the dumbest thing the government's doing is opening up the migration floodgate. Now, I'm a migrant. I came from Poland in 85, okay? So I'm all for migration, guys, okay? I'm a migrant myself. We escaped communism. So I love migrants, okay? And I'm not racist or anti-migration. I'm just saying bring 100,000 or 150 in per year and let us grow the infrastructure, houses, school, transport, in line with migration, so they actually have a good experience in Australia, not stressed out of their minds, with no ability to live anywhere, and then priced out of the market and stressed around everything else. Because ultimately, you and I will pay for it as well. So this kind of, let's open up the floodgates and bring a million people in. Well, come on, it's just ridiculous, And this is why the Labor government is destroying the rental market. The other thing is land taxes is also impacting. I'm going to do a whole YouTube video on land tax. Established houses with large land components, a lot of people are dumping houses because they can't afford the land tax. And then there's going to be more pressure on having energy-friendly, high 4-5-star rating properties that has to be owned by landlords. So they've got to be you got to be energy efficient and have a low carbon footprint. There's going to be new legislation that's going to come in, which is going to create more pressure to upgrade properties. So nothing that I've got will be upgraded except for some of the old houses that I own, but I can afford to update them because I've got a lot of equity. But imagine you got a brand new townhouse. It's already energy rated, but if you've got an older property, this could be a massive issue for you. You might have to spend 50 grand making it energy compliant. So who's going to pay for that? It's going to be a flow-on effect onto the rentals, because if a landlord spends $1, guess where the dollar's going to come from? The tenant. So it's not like you're punishing landlords, guys, which is what the Labor government's doing, isn't solving the rental crisis in the major capital cities. It's having the reverse impact. What they should be doing, and they don't want to because they're very left-wing anti-capitalism, is incentivizing people to become landlords. What I would do if I was in charge would be I would offer teachers and police officers and anyone under $100,000 3 times negative gearing benefits. I would allow them to claim taxes 3 times more than they can at the highest marginal tax bracket. Therefore, that's why, and in that case, all the teachers and police officers and anyone on 70 to 100 grand a year will be able to afford a property. And that pool of additional properties would then ease the pressure on the rental market, and rents will go not down, but they'll stabilize and keep up just barely with inflation. Because at the moment, rents have gone up at extraordinary levels. It's just unprecedented. You can see there 8.5%. I mean, look at that. They shot up by 10% during COVID. I mean, so great for landlords. And in fact, if you've bought well, those increases would have absorbed all your interest rate increases. But if you're trying to rent and you've got minimum income and you've got no asset base behind you, I mean, people are spending more money now just to live and sustain life in Melbourne and Sydney than any other time. It's just crazy what's happening. So you can see there, rental yields have gone up by 3.8% in Australia, which is at inflation. But in terms of like historically 10%, which is crazy. And I've seen 10, 15, 20% in Melbourne in specific suburbs. Dwelling approvals and housing credit, we are massively behind in both housing approval and credit for new dwellings, massively behind. National dwelling approvals rose 1.9% in March, with a 3.6 increase in housing approvals outweighing the 1.8 decline recorded in unit approvals. With 12,947 dwellings approved, the March results were down 2.2% compared to the same time last year, 24.4% below the decade average, 25% below the decade. So we're doing, if you look at Australia, we're doing 13,000 dwellings, let's call it 15,000 per month, okay? Times 12, 180,000 homes. How are you going to do 1.2 million homes just to solve the situation? You can see there, this is where we are, the decade average, and look how well we are below the decade average. You can see there we're way below what we should be creating. There's no incentive to build. Developers are seen as evil, greedy people. They're paying consulting fees, taxes to all these people just to get a project off the ground. No one's incentivizing them to become developers, and they're the ones that are providing a housing solution for our community. And this is to change. It's got to change at the level of psychology, and also reflected in government policies. The government should treat developers like gold and landlords, because then if they did, they wouldn't have to provide social housing, which is not something they're good at managing in the first place. They'll run it into the ground because they can't manage businesses. Because remember, these are politicians and these are professional academics. They never ran a business. They couldn't break even on a lemonade stand. Can you imagine Albanese running a business? Jesus, he'll go into insolvency in 2 days. So this is the problem. So if you want to solve the rental issue, you've got to create incentive for people to become landlords, not the opposite, which is what the government's doing. That's why they're going to be voted out next election, guaranteed. Labor's gone, and Liberals will be in. Finance and lending. So the value of home lending rose 3.1% through March, led by 4.4% lift in first home buyers financing and 3.8% rise in investor finance. With 27.6 billion of new house finance committed, the March result was the strongest month figure since August 22, 27.7 billion, which is cool. So that's healthy. It's recovered. There was a dip. COVID destroyed the whole market with lending, with real estate agents opening up properties, mortgage brokers. So during COVID, the whole thing just went down. Now it's just coming up and recovering and going back to the same level that it was before. Investors now are back in record numbers, but they still have a long way to go, especially now with serviceability, 9.5% P&I, which is the benchmark rate. Because if you're lending at 7%, 7.5%, your assessment rate is 2% above what you're lending, and then it's P&I instead of interest only. So just so you know, let me repeat that. If you're borrowing money at 7.5% interest only as an investor, the banks assess you at 9.5 P&I. And if you satisfy that requirement, they'll give you 7% interest only, because ultimately you've got to have the ability to pay back the loan. And this is the challenge now, is people can't get mortgages. They can't even refinance what they have. So that's a huge, huge problem. So first home buyers, there was a dip there, you can see. And look, they're creating new incentives to get them back into the market. Usually by house and land packages and apartments. They don't really do anything to do with what we're doing here today. But they're a good indicator of what's happening in the market. Once again, construction is massively behind. If you look at Australia, we're 0.03% behind in approvals for April, especially in Melbourne. Victoria is 0%. But if you look at seasonally adjusted figures, from the peak, which was during COVID, ironically, we are just going down, and it's going to continue on. That pattern will continue going down because a lot of businesses are shutting down in construction, a lot of developers going bust, or deferring settlements. I know developers are just sitting on DAs and saying, you know what, I'm not going to build anything this year because I don't know how much money I'm going to make. So I'm just going to go to Europe for 6 months, come back and reassess. So I know a lot of good developers that have really good stock in really premium suburbs. I'm talking like Port Melbourne, Albert Park, Middle Park, Hampton, Sandringham, Black Rock, Williamstown, Moonee Ponds, and they're just sitting back because they can't build those things, because if they do a fixed contract, there's no guarantee they're going to make money. And they don't need to build if they're going to lose money. You're better off just staying out of the market. So you're going to see less and less approvals and less construction activity in that sector, which puts more pressure on property prices and rentals as well. And this is, interest rates being the biggest thing. You can see there. I mean, we went to 0.1%. Do you remember people were saying, can we go negative? I was saying, no, we'll never go negative because you'd be breach of your obligations as director running a company, your Corporations Act. But you go to 0.1 was the lowest point. During that period of time in 2020, if you were to go to my live event, Stephen McClutchy and I were telling people, fix for 5 years, fix for 10 years, fix all your loans. Guys, this is never going to happen again in your lifetime. This is it. Fix as much as you can, or fix 50% at least, so you can grab some equity from the other 50%, leave 50% variable. Those who listened to us cleaned up. Those who went variable, well, they're paying 7.5% now, and which is unfortunate. So, I'm there on record telling people to do this. If you're lucky enough to do it, that's fantastic. If not, well, that could happen again in the future, but I don't see it coming for a long time. Housing credit, so it's recovered, definitely from 21. You can see that it's going up. So people are coming and recovering from COVID, which is a healthy sign, which is cool. And also this gives you the gap between houses and apartments, which we covered as well already. So in terms of summary, this is, and we look, the data, even though it's June, we're always looking back at data. The best data is 3 months old because it takes, usually it probably settles in 60 or 90 days. So the most accurate data we have at the moment is 31st of May 24. We got data from June, but it's not accurate. Melbourne for the month of May did 0.1%. For the quarter, 0.2 negative. So it's going backwards. Annually 1.8. Total return 5.5. So we're just having a breather before we take off and go into the next property cycle. In terms of onset of COVID to May 24, so this is the property cycles. We're looking at Melbourne 11.2, Sydney 27.2, Brisbane 59.8, Adelaide 61, Perth 62.6, Hobart 28, Darwin 26, and Canberra 31. Change from a serious peak of May 24, and then you've got a serious peak date. So this is from the last cycle peak to now, where we are in comparison. So the bigger the gap, the more chances you have of getting a bigger gain. So Melbourne is about to take off, and this is the key thing with the cyclical nature of these areas. Remember, guys, you got to keep the big picture in mind. 20 years from now, an average home in Australia may cost up to 6.3 million in just 20 years, a bombshell study has revealed. Projections show the median house price will reach that figure in Sydney by 2043, up from 1,030,000 today. Aussie Homeowners and CoreLogic survey predicts the average price will hit 5.8 million in Melbourne, that's the median price, 2.9 in Canberra, 2.5 in Perth, 2.3 million in Brisbane, with the biggest increase in Melbourne. And if you look at the median prices today, Melbourne's 780, Sydney's 1.156. So, and Brisbane's 843. So in terms of Brisbane, we'll go from, 843 to 2.3, but Melbourne's going to go from under 1 million to 5.8 million. It's actually the best market to park your money over 20 years because it's the biggest city, and it's actually, the numbers actually work in Melbourne because you can still get 4.5% rental yield in good suburbs. See, Sydney is very good, but it's so expensive now. You're getting rental yields of 2%, 1.5. It doesn't work. You got to put so much money into these properties, and with land tax, it was just going to kill you. So where are we in the national property cycle? So remember, the cycle goes up and down. There's the peak of the market, sideways, bottom of the market, and the recovery. It's about 10 years around the clock. Melbourne was good at the bottom, and you want to buy at the bottom when you can. At the moment, from the latest data, which is May 24, Heritage White Valuers, you can see that Melbourne has now gone to 9 o'clock. Now, majority of the strongest growth is between 9 and 12. 9 and 12, you get double-digit growth, and then at 12, you can even lose money on your property. You can have negative equity. So from 12 to 6, you have downward growth, and then from 6 to 12, you get positive growth. But the biggest growth every 10 years, it's not actually exactly 10 years around the clock anymore because of different factors. And I mentioned this in other YouTube videos, but let's say on average in the last 50 years, it's around 8 to 10 years around the clock. The majority of the strongest growth is from 9 to 12. So we're poised now in Melbourne and Sydney to go from 9 to 12. The more you buy now, guys, you'll set yourself up for the next decade. So the time to buy is this year, next year, the following year, before we get to 12, because that's when everything booms. And so you've got to be discerning. You've got to get your finances in order, do your tax returns. Whatever you do, make it happen. Yes, it's always nice to buy at the bottom. I understand. I've done YouTube videos. I've said to people, this is the bottom, buy now. I understand it. Long term, it doesn't make any difference. Okay, unless you need equity to go again. But long term, it's a long-term game over 10 years. Yes, if you can time the market, it's fine. But I always say it's not time of the market, it's timing of the market. So, when November 22 at the bottom of the property market in Melbourne, I was telling people on my YouTube channel, this is it. We've just turned the bottom. Buy hard now. But remember, it's 321 suburbs in Melbourne and 196 new house and land estates. So what's Melbourne? There's no such thing as Melbourne, So there's not a uniform growth. But what's going to happen is by 2043, less than 20 years from now, Sydney is going to be 6.34 million, Perth 2.4, Melbourne 5.8, Hobart 2.2, Darwin 2.2, Canberra 2.9, Brisbane 2.2, Adelaide 1.9, and the national average will be 2.9 million. Have a look at Melbourne and Sydney, guys. If you knew this was going to happen, guaranteed, what would you do? What are you going to do? Are you going to sit back and watch it happen? Or are you going to take part of your action, part of the slice of this beautiful pie? What are you going to do? Remember, be fearful when others are greedy, be greedy when others are fearful. There's a lot of negative publicity right now around Melbourne and Sydney. Oh, it's going to crash. It's going to do this. I'm just waiting for Harry Dent to come from America with his book telling us how everything's going to go to shit and everything's going to crash. Sell your houses, buy gold. Yeah, that was good. That was good advice in 2008. Yeah, sell your house. That's right. Imagine you sold your house in 2008 when Harry Dent was here last time, and then you held it till today, how much money you would have made. But of course, according to him, it was all going to be blood on the streets by now, right? It was going to be worthless. Australia's impending property boom. The average house will cost 6.3 million in just 20 years. What are you going to do? This is the gold rush, guys. We're in the gold rush of 1851 now. Remember, and it was started by the Welcome Stranger nugget that was found during the Victorian Gold Rush of 1891. A new gold rush has started in 24. It's real estate. And you're the diggers. What are you going to do about it? It's your time to take action, guys. This is it. So don't defer. Get educated. Get market ready. And then get started. So what do you have to do? You have to do three things. Number one is you got to get educated. Without education, you're going to be operating from a place of fear and uncertainty. You're never going to do anything, right? Number two, you got to get market ready. Market ready means you got to get pre-approval in writing, which is called a funding proposal, saying go to any mortgage broker. Don't use banks because banks can only give you banking products. Go to a mortgage broker that's got a panel of 30, 40, 50 lenders, and in writing, get a pre-approval saying, congratulations, George. Based on your current situation, you can borrow 500,000, 1 million, whatever it is. And then you got to get the deposit ready. So you got to get equity released from a property, sell shares, do your tax returns. You got to be able to transact, and then you're market ready, and then you're ready to take advantage of the opportunities. Glen Waverley houses. Look at this. This is land in Glen Waverley, $5,000. Crazy prices, right? This is $200 deposits, $5,000 blocks of land. In Glen Waverley, by the way, in the 1960s, this house would have cost you £3,375 to build on your land. Let's call it $7,000 in today's money. A 3-bedroom brick veneer entry level. This was the cheapest house. Most of them cost around $5,000 to $6,000 if you wanted 4 or 5 bedrooms. But this is like the cheapest house on a 700 square meter block in the 1960s. And people saying back then it's unsustainable. It's going to come crashing down. How much are they selling today? 1 million. So $7,000 to $1 million since 1960. Do the cycles every 10 years, doubles. This is Brunswick West in Essendon. So it's £150 per block, £10 deposit, 1800s. It's the same thing now, guys. Nothing's changed. It's a gold rush, except it's real estate. And this is what happened to median prices in Australia since 1880. Have a look at that growth. It's all because of population growth. If there was no population growth, there'd be no capital growth. There's more and more people trying to come into the country than ever before. They're coming in where we have now the opportunity to bring in skilled migrants. So we're letting in people into IT, biotech. We get to choose the industry that we want to fill in Melbourne, in Sydney, in Australia, right? So we're not just letting people in willy-nilly with no education. We're getting people that with specific skill sets to grow the country, grow the economy. And a lot of these clients, a lot of these people that are coming in from China, from India, from Europe, from America, they're in the job for 12 months. Once they do their tax returns and save money, they're going in hard and they're buying houses. So there's going to be short-term volatility, but long-term, this market's going to boom. It's going to be so expensive in Melbourne, people are going to be shocked how quickly, when we go into the next growth phase, how quickly prices will come up. I'm telling you. So you just got to do whatever you can to get into it. Otherwise, you're going to miss the boat permanently. And yes, a lot of people already now on incomes like 70, 80 grand are completely priced out of the market in Melbourne. They can't buy anything. So I hope you enjoyed that summary, guys. I hope I've inspired you and created a bit of urgency internally for you to take action and become a successful property investor. Now, a couple of things I mentioned before. If you're interested in learning more, definitely you're welcome to attend our up-and-coming 2-day real estate investing fast track weekend, which will run in our office in St Kilda. I run around 6 to 8 of these per year. I'm pretty lazy. I don't work that hard anymore. I enjoy my days off, and I have 6 holidays a year, so I should do more, but I just don't need to. I enjoy doing them. I actually genuinely enjoy doing these 2-day events. People have a lot of fun. They get a lot of information out of these. Tickets are $47. You get a copy of my book, which is like the manual for the 2-day event. So you get a hard copy of my book as well. And look, we don't make money out of these events. We just cover our lunch because it's fully catered, and the copy and the cost of the book. During the 2-day event, you're going to discover exactly how to become a sophisticated property investor, how to conduct unbiased due diligence and research on the property market, how to understand property cycles state by state, exactly what to buy now, detached houses, old houses, new houses, townhouses, villa units, apartments, brand new, old, identify what type of properties to buy, which structures to buy them in, and it's very specific based on your specific set of circumstances. Also, we do a mortgage reduction program. Steve and I will teach that how to slash tens of thousands of dollars of your mortgage and have your 30-year mortgage reduced to 10 years or less without making additional repayments. So how to restructure your mortgage and then use the equity from that to passively build your property portfolio. How to maximize your structures for tax maximization, DSR ratios, how the banks work out how much money you can borrow, 18 powerful ways to supercharge your borrowing capacity, 19 critical questions you need to qualify your mortgage broker in the industry. Mortgage brokers are so useless, guys. The industry is filled to the brim with extreme incompetence. You got to really be discerning with mortgage brokers. It's crazy what's out there. I'm talking to these guys every day. I'm shocked. 12 most common deadly sins of property finance, and then how to understand how to balance your property portfolio between cash flow positive and negatively geared properties, and much, much more. Tickets are $47. Jump onto realestateFasttrack.com.au. Reserve your seat before they book out, and I hope to see you there in person. If you can't make it to the event, you can get access to my home study, which is a video recording of the event from a few years ago, absolutely free, instant access. You just got to scroll down below this video, and there's a link there that gives you instant access to these video courses. There's nothing to buy. There's no upsell. It's just my gift for you, just so you can get educated. Once you're in there, you literally just put your name, your email, you get a password, you can start watching the videos. It's a recording of the 2-day. Same things are covered, except obviously it's 2-year-old information. So you're not getting the latest information on finance, on legislation, on whether it's interest rate products, and obviously the banks have changed policies and interest rates are different, but fundamentally 70%, 75% is still the same. Nothing's really changed. So it's 10 hours of video and a 265-page manual. It's full on. It will take you a few days to get through. Most people watch it over a month. They chunk it into 2-3 hour slots. But definitely it's worthwhile watching that. You're going to learn more than 99% of all investors in Australia by understanding that information. So definitely encourage you to get access to that. It's free, guys. There's nothing to buy, there's no credit card requirement there. You just email, access immediately, and you're in. It's my gift to you. Now, for some of you who want to use my property sourcing services, definitely encourage you guys to catch up with me for a 60-minute strategy session. So if you're interested in building wealth passively, buy and hold in Melbourne in blue chip areas, because that's all I do. I'm a sourcing specialist. So I go out there, identify the best suburbs and identify the best builders and developers in those suburbs, and I source properties for my private clients. That's all I do all day. So those who are interested in buying Melbourne properties, I can source those properties for you. I can help you with that. I'm a real estate agent. That's all I do all day. I don't charge for my services at all, because I'm a real estate agent. I get paid commissions from vendors, developers, and builders like a normal real estate agent. So instead of using me, they would have used Ray White, Hocking Stewart to sell their property, but they come to me because I deal with investors only. I don't deal with owner occupiers. I only deal with investment stocks, so townhouses, detached houses that are there, but I source them based on the fundamentals: capital growth potential, rental yield, depreciation, etc. Not, whether you like the carpets or the butler's pantry or etc. So we start off with an idea. What we do during the 60-minute strategy session on Zoom, I sit down with you, I work out where you are, where you want to be, and I give you an honest feedback about what's possible. So we turn an idea into a plan in action. Remember, if you fail to plan, you plan to fail. So sometimes sitting down with someone like myself, who's been doing this for 25 years, and just looking at your situation, from a financial perspective, I can just give you some hints and tips that will save you years of frustration potentially, and fast track your wealth accumulation, to a very high level. Most people waste so much time, and they go from A to B like that, where they do all this crazy stuff. They end up buying the wrong properties and houses in Point Cook and South Bank and Docklands, and then they do selling treadmills on Amazon, and they do cryptocurrency, and then they come back and they're nowhere near what they want it to be. If you have a team of experts around you, if you have a good plan, you can become wealthy very quickly. When I say very quickly, 5 to 10 years, you can accumulate substantial wealth in Australia. But you got to be smart and patient, and you got to have the right team with you. So initially, I sit down with you for an hour, work out where you are, where you want to be. I'll show you how to bridge the gap between A and B. Then I'll introduce you to my mortgage broker, accountant, property solicitor, conveyancer, quantity surveyor, insurance specialist, right down to property management, financial planning, the whole team. So you get the whole team, and these guys know each other, and they are the best in the industry. So I've known, for example, Colin for 25 years. He's my lawyer. I've known Stephen McClutchy for, I met him when I was 21. I'm 48. So I actually met him 27 years ago, which is crazy, more than a quarter of a century. I've been referring clients to him. James Blake, I've known 15 years. So you've got to have your whole team assembled, and they've got to be property experts themselves. And this is kind of what your team will look like. And then you can work out a strategy and how to move forwards. And look, what I do with my clients is I give it to you in writing. It's step by step, paint by numbers. You can't go wrong. Now, the minimum qualification for it is, unfortunately, we have to live in the environment of financial services and affordability and lending restrictions. So if you're a single person, you need to be kind of a 95,000 per year, with about $126,000 in equity, which you can take out at least 112,000. That will qualify you for a 700 purchase. Or if you're qualified for a 700 purchase plus, you can come and see me. The cheapest properties that I source are 695. There's nothing below 695 that I have. So, the chances of me helping you under 700 is extremely remote. And I'm not going to go into second-rate suburbs just because your affordability is low. If you're a couple, you need to be kind of in that 140, or once again, or pre-approved for $140,000 or $700,000 purchase, and the ability to close the transaction, which means you got stamp duty and deposit there, or equity in your home. That's no problem at all. So for those who are interested, simply send me an email, conrad@investorsprime.com.au, and just put requesting a Zoom meeting or strategy request. Don't need to put any details there, just your email that you want to book in with me, and I'll reply. That's my personal email. If you've been to a live event, there's a form that you get. Send me the form, and then I can fill it out, and I can contact you. And that's it, guys. I hope you enjoy these contents. Hope you'll learn a little bit from this video. This is Konrad Bobilak wishing you best in investing. I'll see you on the inside.